Hi everyone, and welcome to episode 2 of the Introduction to Forex Trading series. In this episode, I'm going to be giving you an introduction to the financial markets and to trading. Before we can start trading, it's important that we understand what we're actually doing and how we're going to be doing it. To provide you with this information, I'm going to be introducing the principle of economic exchange, introducing financial markets, discussing CFDs, and exploring a range of different asset classes which we may find ourselves trading on in the financial markets. If you're a beginner trader, this will be a very important episode, so grab a notebook, tune in, and let's get started. To get started with this lesson, I'm going to explain exactly what a trade is from a very fundamental level. A trade is an economic exchange. It's the swapping of goods and services for currency. The principle of economic exchange states that when goods and services are provided, payment is due either in the form of currency or other goods and services. Typically, people will prefer the currency option because it's just more efficient. By integrating the principle of economic exchange into society, humanity has been able to evolve very quickly. The reason why is because when you create a centralized currency or store of value, people have a medium to exchange for goods and services. Going back a couple thousand years, if your job was to make and sell bricks, without the principle of economic exchange, all that you could do to acquire other goods and services would be to sell bricks. This is known as the barter system. However, if there is no demand for bricks, then you would have no way to acquire the goods and services that you need to survive. To increase the overall efficiency of this transaction, humanity invented economic exchange. Now, you can sell bricks for currency and use that currency to purchase whatever you need from the economy. This is a very simple example, but it's important to understand the fundamental principles of economics if you're going to be a trader. As the complexity of the economic system increases, the need for a more organized system starts to appear. In our society, this comes in the form of the financial markets. Financial markets list companies, currencies, and other stores of value. A company listed on a financial market is a very complex entity which solves problems for society in exchange for economic compensation. A currency listed on a financial market is a widely used medium of transaction. They typically belong to either a country or a region. The financial markets is a massive network which tracks and distributes ownership of these assets to different people, companies, and governments. It is a timeless, spaceless, global distribution system. Financial markets also include more complex assets such as bonds, indices, cryptocurrencies, and real estate investment trusts. Okay, so with this basic information out of the way, we can now get onto the topic of trading itself. Trading is an activity where investors buy packages of these assets which we've just been talking about. The objective is to buy a package of assets for a certain price and then resell it later for a higher price. The goal is to make money, and this is done by viewing the available data and making educated speculations based on pattern recognition and probability analysis. The fundamental essence of the activity is to place yourself on the right side of advanced supply and demand dynamics. By taking positions on the right side of these scenarios, you have the potential to make a large profit. One of the reasons why trading is such a powerful income generation model is because it's highly scalable. This is because there is a very large volume of currency passing through the primary financial markets, making it possible to trade large accounts. In the preceding episodes, we'll be talking more about different trading styles and strategies, but at this stage, we're still working through the really fundamental information. There are different ways to trade financial markets which allow for different styles and varying levels of trade flexibility. A very popular financial product which we use here at Alchemy Trading is the contract for difference, better known as a CFD. A CFD is a contract between a buyer and a seller, stipulating that the buyer will pay to the seller the difference between the current value of an asset and its value at a later point in time. CFDs are very useful because they allow us to trade without taking physical delivery of the underlying asset. What this means is that we can go ahead and buy several thousand barrels of oil without having to worry about where we're going to put them. CFDs also allow us to take positions on what's called a currency pair. A currency pair is simply two different currencies compared against each other. It's important for currencies to be compared against other currencies because independent value is an abstract concept. We can't say that a single brick is worth something unless we compare it against something else, as that would violate the principle of economic exchange. The same goes for the US dollar. It doesn't possess an actual value until you compare it with something else. Currency pairs compare the value of one currency to another. The first one, which is called the base currency, versus the second one, which is called the quote currency. So what a currency pair indicates is how much of a quote currency is needed to purchase how much of a base currency. Furthermore, you should also understand that currencies are identified by what's called an ISO currency code, which is a 3-letter alphabetic code which they are associated with on international markets. So, for the US dollar, the ISO code would be USD, and for the euro, the ISO code would be EUR. So, to provide a practical example here, when trading the currency pair which compares the euro to the US dollar, the pair is going to be named Euro USD, EUR USD, which is a combination of the two currency codes. And finally, before we move on from this basic topic, I want to mention that because CFDs are a dual structured trade, meaning there are two currency pairs involved, you can actually take two different types of positions. You can take a long, where you buy the instrument, or a short, where you sell the instrument. When you take a long position, it's called being bullish, and when you take a short position, it's called being bearish. This language is very heavily used in the trading space, so it's good to commit it to memory. Having the ability to buy or sell any currency pair is a major advantage that Forex offers for your trading. So with that said, that brings us to the end of this episode. In this episode, we've covered some important beginner trading and finance concepts. If you are new to trading, this is an episode which you'll want to watch twice, because these fundamental concepts are important for your trading. If you got a bit confused when I started talking about CFDs, there's no cause for concern. They are actually very easy to execute in practice, and you'll develop an understanding of the theory as you make use of them in live markets. So, with that said, thanks for tuning into this episode, and we'll see you in episode 3, where we're going to be discussing the primary trading analysis tool, which allows you to view the markets in real time. Thank you.